morning, Gilbert, and welcome to all the investors that are checking in from around the world today. We're pleased to present and excited to tell you more about our company. And I'd like to invite anybody to send me any questions via email if we don't have time to get to them during the Q&A. And also a special thanks to the team at NAI for helping us translate these slides in advance of today's event, which was very helpful. So without further ado, I'm going to share my screen and we will begin. Good afternoon. My name is Keith Pivonski, and I'm the Vice President and co-founder of Energy Finders. And prior to joining the company, I owned and operated Underwood Associates within the green infrastructure industry, where we earned and recorded over $100 million worth of design build construction revenues over the past 11 years. So I'm very familiar with the green space and anxious to get involved at integrating the energy and environment technologies that we'll be discussing today. While I would say that my specialty would largely be considered ecology and land restoration, I would also say that our North Star in terms of passion is the combination of clean technology and capital markets, which have the power to reshape how we build and interact with our planet at scale. So, what is Energy Finders, and how do we intend to capitalize on the growing clean energy sector, which will soon need to support a planet with an excess of 9 billion people? Foremost, we are an emerging clean technology company with a core focus on net plus energy and environment technologies, which we believe will reshape the future of resilient community scale microgrids. And when we say net plus, we're really referring to the natural maturation of net zero, where we're taking things beyond achieving zero and we're actually bringing a positive impact to the community and to the developers and stakeholders involved in our project. My goal for today's presentation is to better explain what makes our approach net positive as opposed to net zero when discussing the financial. So what is the problem that we're addressing that's manifested locally, but really a worldwide issue? And the problem is that our aging grid was not built with 300 million people in mind, and over 95% of the utility scale renewable energy projects require downstream infrastructure upgrades before the interconnection can be approved. When you couple this with the bipartisan infrastructure law funding, we're left with a $10 billion logjam of renewable energy projects within the United States alone, with more than 2,000 gigawatts currently waiting for approval to be brought online. To further complicate this, many states have adopted aggressive renewable energy mandates without a clear and obvious path for them to meet this mandate or requirement. The reality is that the local utility providers claim that their hands are tied if the adjacent infrastructure needs to be upgraded prior to that interconnection approval. This leads to the various project parties arguing over who shoulders the cost and a lengthy, broken interconnection process for energy providers. So how can Energy Finders fix this billion-dollar issue with a transformative first-in-kind approach? We address this by acquiring strategic vacant real estate in overlooked and undervalued high energy burden communities, where you often find the most old or inefficient buildings that tend to place the highest strains on our aging grid infrastructure during that peak demand. We then partner with existing design build experts to develop a next generation community scale microgrid that is designed to cut the customer's cost by at least 10% during the customer discovery and design process. What makes these microgrids unique is that we employ the use of silica-based soils, which promote natural groundwater recharge while simultaneously generating stormwater TMDL credits, which can be sold to the city or municipality that's installing the project. In essence, we acquire the land, we clean up and optimize the soil conditions, and we then build a microgrid that is capable of serving multiple human needs within one three-dimensional footprint. So who's our first customer and how far along is our first development site? We acquired our first site early in January of 2004, and we immediately completed the initial site clearing and cleanup. We're now working with our first two partner companies, Chaberton Energy and Underwood Associates, to apply for grants which would fund up to 100% of our site development cost. Energy Finders is poised to become the independent owner-operator of the microgrid once it's brought online, and we'd like to highlight that our microgrid will be connected directly to the school, customer, and recreation center without any reverse connection back to the grid needed for it to be installed. What this does is allows us to skip the 2 to 3 year wait for interconnection and begin generating revenue as soon as the site is permitted, constructed, and online. It also allows us to build a portfolio of 7 to 10 pilot sites for future research and development for the proprietary EGYF technology, which we'll talk a little bit more in today's presentation. What I love the most about this business model is that growth is built into the DNA of our new company, where we're either looking for opportunities to make money or we're making money through the design, construction, or power purchase agreement of the microgrid itself. This model allows us to focus on our core competency and to minimize our employee overhead while developing our first primary revenue stream. It also allows us to build our own development queue of projects, which are each in various stages of development, and ensures that we're consistently working towards increasing our power purchase agreement revenues as we bring on more projects in the future. As you may expect, the global energy market is quite massive, with a TAM of over $2 trillion and a service obtainable market of over $1 billion forecasted for Energy Finders. In our opinion, our first pilot site will serve as our rinse and repeat template that can be replicated and further optimized as we adjust to the learning curve that we're working through right now. Over the past 4 to 6 weeks, we've opened new conversations with potential customers in Texas, Colorado, California, and Connecticut, and it's been fascinating for us to learn why each new customer views our approach as disruptive. An example of this would be our potential customer in Texas, who's a real estate developer who recently incurred an unexpected $2 million cost increase when the local regulators required them to implement new stormwater best management practices within their ongoing 45-acre site development plan. The key milestones I'd like to highlight are as follows. We're currently completing a 1-year audit of our financials in preparation for filing our Form 10 registration in June. This will bring the company to full SEC reporting status once we've responded to the likely questions that the first back and forth with the SEC will present. We've completed all of the necessary Form 211 paperwork to be eligible for proprietary broker-dealer quotes. And the one thing that's holding this up from being finalized is that our current private placement round is open, and FINRA will not acknowledge our 211 paperwork until we notify the SEC that that private placement round has been closed. We're currently in negotiations with a large private investor as well as an investment bank to help us close our current funding round. And we believe it's imperative to highlight that our ability to close this funding round as soon as possible will drastically impact our ability to meet the dates and the revenue targets that are mentioned in today's presentation. So in terms of competitors and secret sauce that Energy Finders has that would enhance our capacity to make ourselves a $1 billion company, it's really no denying that there's really a David versus Goliath story in its infancy stage when you compare Energy Finders to the other public companies operating in this space. But we'd like to highlight just how similar all of our competitors are in terms of how they generate their revenues. And to our knowledge, we're the only public company in the world right now seeking to commercialize a new form of CPV technology in the form of our proprietary EGYF product, which you can see on the left-hand side of the display. What makes this EGYF product especially exciting was the recent news released out of Lehigh University 8 days ago, which disproves the Shockley-Kaiser theory for solar cell efficiency through the use of germanium selenide and tin sulfide within the solar cell's architecture. It's long been theorized that traditional solar panels could not achieve a peak efficiency beyond 20 to 40% as you get into heterojunction solar cells, but new research is showing that upwards of 190% cell efficiency can be achieved using these advanced photonics and quantum-based semiconductors. Energy Finders intends to continue to develop this e-box technology in partnership with some of the research that's ongoing within this industry. And our intention is to bring this technology to market as soon as next year. So what does this mean for revenue forecasting? We understand that it's arbitrary to predict revenues beyond 6 to 12 months, but we do believe that it's very important for us to set goals which we believe we can achieve and to help our prospective shareholders really grade our management team's ability to grow the new company. We generate, we generally expect about a 1 to 2 megawatt microgrid project to take between 10 and 20 months to complete based on a variety of factors, from the customer discovery phase all the way through the site conditions, as well as the existing design permit landscape within each of the areas that we're looking to do business. It's also worth noting that the power purchase agreements that we sign would be for a period of 25 to 30 years, which means if we take that first site in this Baltimore City and we extrapolate our estimated revenue of $165,000 a year, we would expect to generate around $5 million over the operating life cycle of that first system. What's more exciting for us is within that development approach is that as we combine these solar and battery storage federal tax credits with the local TMDL stormwater credits, we believe we can achieve an industry best payback period while incrementally growing our microgrid portfolio year over year, improving the likelihood of consistent shareholder returns. We have seen some familiarity with other solar sites that are introducing pollinator habitat underneath the solar panels as an added benefit, but there's currently no other developers in the world that are looking to mass introduce an equal or even double the amount of acres of stormwater into their renewable energy site while simultaneously recharging a groundwater table and improving water quality within the environment. Our founding team consists of 3 entrepreneurs who have each achieved significant individual successes in their private businesses before agreeing to join forces and bootstrap Energy Finders to being a fully SEC reporting company traded on the OTC QB market. Our CEO, Mr. Zulfikar, is the technological architect and the inspiration within our company, having successfully founded and exited Media Technics in 2005, Data Technics in 2015, and IntelliClad in 2021. Our CFO is a seasoned CPA with over 30 years of consistent results, including numerous exits from either UK or US-based private or publicly listed corporates. And I would consider myself to be a highly motivated seed investor who's really eager to learn and perfect the art of growing a public company from a shell company to a $1 billion valuation over the next 5 to 10 years. It's also worth noting that I've been an investor on the OTC and the NASDAQ market since 2008. And so part of my motivation is taking a lot of what I've learned and seen in terms of previous successes and failures of companies that I've invested in and bringing the good and not the bad into Energy Finders as we work forward on our mission. We've additionally highlighted 3 potential contractual scientists who've expressed interest in working and collaborating with us in the near future. And I'd like to say that having personally recruited each of these candidates over the past 8 or so months, we're confident in our ability to attract talented individuals upon completing our pre-seed fundraise. This leads me to our most important slide, which organizes our current fundraising ask and our expected ask as we move into what is expected to be a Reg A plus capital raise for a larger amount of money next year. We've currently received over $450,000 in deposits and $600,000 in new commitments as part of our $2.25 million pre-seed round. And our main reason for presenting today is to increase the awareness and liquidity surrounding our stock while simultaneously connecting with potential high net worth individuals who write check sizes in excess of $150,000. We've organized the expected milestones and deliverables within our fundraise at the bottom of the slide, and we would like to highlight that we're planning on investing a significant amount of our fundraising money into organic awareness and marketing as part of our goal to uplist to the QB exchange once we become a fully SEC reporting company, hopefully a little bit later this year. In general, our big picture is to achieve a market cap in excess of $100 million within the next 24 months, and to have at least 2 active revenue streams by 2025. If we have time for a few questions, I'd love to pivot at this point and open up the Q&A portion of today's event. And if we don't have enough time, I'd remind everyone to please use the email that's listed here to send any questions to us, and I'll be happy to answer them as soon as possible after today's event.
Great, Keith. Okay, let me take a look at some of the questions here. And this one from Jaden, maybe from the Chinese channel. He wants to, maybe you can elaborate more on your management team, there any like successful stories from before, the background, the track record.
Sure. So our CEO is really one of the godfathers of semiconductors. He really worked along with NASA and Ericsson Defense Systems, as well as one of being the first 60 employees at IBM Computers. And so he has a long history within semiconductors and mainframe computers, which really drove the architecture of this e-box technology that he was theorizing. He's exited, as I mentioned during the presentation, 3 companies before. And so Energy Finders is really looking to be the culmination of his career work in semiconductors, and hopefully the most successful of the prior companies that Mohammed has worked under. Our CFO has more recently worked on 2 different companies in the UK and the US. He's actively negotiated numerous mergers and buyouts while working for a UK company that acquired US companies. And he's able to work for Energy Finders for no salary on behalf of being a co-founder due to the successes that he's achieved in his prior work. So when we talk about the experience and what each of us bring as co-founders, it's imperative to think about the fact that we each can support ourselves financially without pulling a salary from Energy Finders. So we're really in a position to preserve our cash flow as much as possible to drive the business forward, as opposed to having to pay ourselves.
Good to know. And this one from Malik, and he's asking, when you said acquiring undervalued real estate, how will you mitigate the potential risk?
Sure. So it's a great question. Part of my passion and the work that I've done over the last 12 years has been working with EPA, Environmental Protection Agency, as well as Maryland Department of Natural Resources, to talk to them about soil contaminants and the technological approaches we have in the environmental world to combat these contaminants and to help mitigate some of the costs that arise when you're working in brownfield redevelopment. What's exciting is that EPA has recently announced billions of dollars worth of grants that will allow us to de-risk these brownfield sites, putting the upfront testing on the EPA through these grants that will allow us to identify the key contaminants in the soils using grant money, and then develop an approach towards redeveloping the site afterwards once we've already had that contaminant addressed and really quantified as part of the upfront due diligence. But I would say it's important to highlight not every brownfield's contaminated. When we talk about a brownfield, it could be anything from a site that had a house built on it that collapsed, that just needs to be cleaned up, or a facility that used to operate that could be renovated into something totally new that has no active contaminants on it. So unless that research is done, a lot of times people will be fearful of even tackling these sites out of fear of a contaminant that may not even be there. And so these sites tend to stay dormant for pretty long periods of time, unless a company like ours that can better quantify the risk and work with the regulators is able to go in and tackle that site.
So one last question before I let you go. He's asking, is your business capital intensive? Because you talk about raising capital.
It is upfront. I mean, we're not relying entirely on the fundraise, which is why we chose to partner with some really strong companies local to our area and to apply for grants. But it's really a parallel process of working under grant funding and then also working under our own fundraise to bring these projects forward. What we would need is about at least $1 million as part of our pre-seed fundraise to finish this first site and the first half of it on the land side. and then another $1 million to really move these next sites further along in our development queue. So yes, it is dependent upon raising the capital that we're in the process of doing, but it's not entirely dependent on it. And the investors that we're actually speaking with now have taught us that we were really not raising enough money initially. We're finding that it was easier now to have conversations at the $5 million level than it is at the $100,000 to $200,000 level, for that exact reason of how much money you would need to raise to bring one project over the line. We actually found that the investors agreed that we needed in excess of $2 million on a per site basis. And so we've raised our targets, and we'll be reacting to that as part of our ongoing negotiations.
Thank you, Keith, for your time here with us today.
I appreciate it. I look forward to having me again next time, and look forward to a great conference.
Thank you.